A. Understand factors contributing to inconsistent definitions of equity, assets, and return in ROA and ROE. Different analytical definitions of return create inconsistency in ROA and ROE calculations. Return may be defined as net income, operating income, EBIT, NOPAT, or comprehensive income. The choice affects comparability and interpretation, particularly when comparing firms with different capital structures or tax situations. Asset measurement differences affect ROA. Analysts may use total assets, average total assets, operating assets, or assets excluding non-operating investments. Inclusion or exclusion of goodwill and intangible assets also changes results. Equity measurement variations affect ROE. Some analysts use beginning equity, ending equity, or average equity. Adjustments for preferred stock or accumulated other comprehensive income further alter comparability. Accounting standards and managerial discretion influence both numerator and denominator. Therefore, consistency and clarity in definitions are essential for meaningful analysis. B. Determine the effect on return on total assets, ROA, of changes in financial statement elements. ROA is calculated as net income divided by average total assets, so changes in either component directly affect the ratio. An increase in net income, holding assets constant, improves ROA and signals enhanced profitability or efficiency. Asset growth without proportional income growth reduces ROA. For example, major capital expenditures may temporarily depress ROA until the assets generate revenue, highlighting the importance of timing in investment evaluation. Cost structure changes influence ROA. Reductions in operating expenses or improvements in gross margin increase net income, thereby increasing ROA. Working capital management also impacts ROA. Excessive receivables or inventory increase total assets, lowering ROA if not accompanied by higher earnings. Understanding these interactions allows managers to evaluate strategic decisions and their profitability impact comprehensively. C. Identify factors to be considered in measuring income. Income measurement depends heavily on accounting estimates and judgments. Depreciation methods, bad debt provisions, warranty estimates, and asset impairment decisions can significantly influence reported earnings. Choice of accounting methods affects comparability and income timing. Revenue recognition policies, inventory valuation methods, and lease accounting treatments may accelerate or defer income. Disclosure incentives and managerial motivations influence reporting. Managers may engage in earnings management to meet targets, influence stock price, or satisfy debt covenants. Different users have different needs. Investors may focus on sustainable earnings, creditors on cash flow stability, and regulators on compliance, requiring careful evaluation of reported income quality. That high-quality income is sustainable, transparent, and supported by strong operating cash flows. D. Explain the importance of a source, stability, and trend of sales and revenue. Revenue is a primary driver of profitability and long-term sustainability. Analyzing the source of sales, core operations versus one-time transactions, helps assess earnings quality and recurring performance potential. Revenue stability reduces risk. Companies with diversified customer bases, long-term contracts, or subscription models often exhibit more predictable cash flows and stronger financial resilience. Trend analysis reveals growth trajectory and competitive positioning. Consistent upward trends indicate market strength, while declining or volatile revenue may signal competitive pressures or demand issues. Revenue composition matters. High-margin product lines contribute differently to profitability than low-margin segments, making segment analysis essential. Understanding revenue dynamics supports forecasting accuracy, strategic planning, and valuation decisions.